Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Hugh Rogers of Puma Investments. Hello, Hugh.
Hello.
First off, could you just tell me a little bit about Puma, who they are and what they do?
Certainly. Puma Investments is the tax-efficient arm of Shaw Capital Group. Shaw Capital Group was started in 1985 by Howard Shaw, who remains our executive chairman to this date. And we've been running VCTs since the launch of the first Puma VCT in 2004. And since 2004, we've raised over £200 million to date, £225 million to date. But the figure I like to say is that we've repaid back to investors £98 million in dividends and liquidation distributions. That's because we sit in a very specific area of the VCT market. We sit in what's called, or has traditionally been called, the limited life or planned exit sector of the VCT market.
And you've just launched Puma VCT 13. What exactly does it aim to do for investors?
Puma VCT 13 looks to continue as much as possible what we have been doing over the years. So we look to invest into established companies that are revenue generating, that are profitable, but we always look to invest with an eye on the exit. As I've said before, the raison d'etre of Puma VCTs is to actually wind up at some point in the future and return capital back to investors who have been in there for a long time. So Puma VCT 13 is no different. It's looking to wind up at a certain point in the future, but given kind of current legislation or current planned legislation, that's being pushed out from the normal kind of 5.5 to 6.5 years, more to 8 years. So it's a longer timescale, but the investment team, the investment philosophy, the investment strategy are remaining very similar.
So to be clear to investors, you'll aim to pay them a dividend of X over a number of years, and then in year 8, hopefully return that money, any balance back to the investor.
Exactly.
And typically you're looking to take perhaps a lower risk than other VCTs?
Well, it's a difficult thing to say, lower risk, because that leads to connotations in people's minds. What I always say is that there is risk. We're investing into unquoted companies. We're taking equity stakes in those companies, but we try within our investment strategy to limit the risk as much as possible. We try to back companies that are run by experienced management teams that hopefully have an asset that we can take security over, but they have to have also what we call skin in the game. We want them to have established a company, set it up, got it post-revenue generating, have invested their own money in it, and therefore they're very focused on making it a success, and therefore we can come in and then help them achieve what they want to do within their company. And
any types of companies you would avoid?
We avoid early stage companies, seed companies, startup companies. We typically avoid anything with a binary outcome. What I mean by a binary outcome is, for example, a technology company or a healthcare company whereby they put a lot of money into a certain project and it either works or it doesn't. And we try to avoid those kind of companies. We don't want to have a kind of, it will either be very successful or nothing. We look to avoid, that's what we look to target companies that are revenue generating and already have a proven business model. We're not interested really in finding the next Facebook or Google. We're not interested really if somebody comes to us and says, I've got a great app and I need £2 million to spend on marketing promotion to make it work. That's not our kind of area at all, basically.
So do you want to give me a few examples of companies you've invested in?
Sure. One of the ones we've done recently is a company called Growing Fingers. This was a £2.8 million investment into children's nurseries. What we like about children's nurseries is that obviously there's a lot of demand for good children's nurseries. There's a building there that we can take security over, but what we liked about Growing Fingers is they've already done a number of nurseries. They've already shown that they can get these up and running successful. They're already revenue generating and profitable, and they're looking to expand a proven business model. It's the same with Welcome Health, which was a number of pharmacies around the north of England, and again, very much a kind of a need kind of market. People are needing medicines, people are needing pharmacies, and again, we liked what they'd done already, and then we came in to help expand them out. Lastly, Warm Hearth, which is the name of a company which is looking to expand the brewhouse and kitchen pub chain. So we've done an awful lot of brewhouse and kitchen pubs that started off with just one pub in Portsmouth, but they now got over 20 pubs around the country, and they specialise in doing their own brewing on site. So they're very high-end pubs, very kind of food and drink orientated, and are destination pubs in city centres and in market towns.
And where do you typically get your deals from?
Well, we've been around for a long time. Shore Capital Group has a very extensive network of contacts, and we've been around for 31 years. And also Puma Investments itself has been in this area for 13 years now. So we have an awful lot of our own kind of contacts. We have offices in London, Liverpool, Edinburgh, Guernsey and Berlin. So we're part of a much larger group which brings in its own network of contacts. We also have the usual contacts with the normal broker introducers, but word of mouth is actually one of the better ways of us getting deals, because if people deal with us and they like what we do, then they're going to recommend us to their colleagues and their friends, really.
And what typically would an exit look like for you?
The exit's really what we have our eye on at the time of making the investment. It's really the kind of the crux of what we do. It's not kind of, is this investment going to make us all millionaires? It's how are we going to get our money out? Because we never forget, it's not our money, it's our shareholders' money, it's our investors' money, it's our clients' money. So we're always focused on how we get the investment out. Most of the time, it's a trade sale to another counterparty. Often it's a management buyout, but it's really the kind of no deal gets signed off until we have at least a very good sight of how we're going to get our money back. Obviously, there's no certainty, there's no guarantees in this industry, but we are focused on how we're going to get the money back for our investors.
And in terms of companies you have invested, is there any ones that have worked out particularly well?
Again, we're not trying to do 10, 15, 20 times multiples on the money we're putting in. We often invest in a combination of debt and equity, and we're looking to generate a very steady, stable return. So again, we're focused more on the downside than the upside. I'm not saying every company that we've done has gone swimmingly well, but we've never really lost money on any kind of VCT deal over the last 12 years. So we're very good at getting money back, even when things don't work out.
Legislation changed in 2015, which restricted slightly what you do, and there's a lot of talk that there might be further restrictions to whether it's asset-backed investment. How did it affect you initially, and what can you do in the future?
Well, we've been running VCTs for many years, and if we cast our mind back to what we were doing back in 2005, 2006, 2007, there were very different VCT investment rules back then compared to now. So we've always evolved our investment strategy to fit in with the rules, and that's just part of what VCTs and latterly EIS investment are all about. Undoubtedly, the dial is turning to point VCT investments in a more risky direction, and everybody has to understand that, and it goes really back to the days of maybe solar EISs, which were pretty low risk within an EIS category, and the government weren't happy that people weren't taking much risk to get the generous tax breaks on offer. And so ever since then there's been an evolution. Back in 2015, they said that VCTs can no longer do MBOs. Now, we didn't do MBOs, but again, it's continually evolving. There's a budget coming on the 22nd of November. We don't know what rule changes are going to be in there, but we feel that we've got a very deep investment team. We have a very broad investment mandate, and we have an awful lot of companies that are ready for investment that will fit in with whatever criteria come. But unfortunately, the uncertainty ahead of the budget is causing a little bit of a kind of a bit of fog in the market, as it were, basically.
And finally, Hugh, if I'm going to invest in a VCT this year, why should I invest in yours?
Well, I always make it clear when I speak to people about our VCTs that we're in a certain sector of the VCT market, and if you're looking for very high levels of return, there are other VCTs out there that can do that very well indeed. So if you're looking for maybe a more conservative VCT that is more looking at the downside protection and at a defined end date, then we're the ones that you want to talk to. We're also able to pay a regular stream of dividend over the time period. So if you're looking for tax-free income, if you're looking for a more cautious investment strategy within the VCT sphere, then we'd love to have you as a shareholder.
Hugh Rogers of Puma Investments, thank you very much.